Hi everyone, I'm Andrew with Jesani Wealth Management, and on the topic of structured notes, whether it's structured income notes or structured growth notes, dual directional, step-ups, could be any type of structured note. They're all issued by the major banks. So as an investor, you're going to have two primary risk categories in that investment. One is, of course, that the underlying asset, whether it's an index or an individual equity, declines in a value greater than that of the barrier. So essentially what you have is market risk, similar to if you invest in equities. Now, we know that structured notes, because of the barrier levels that they have, you're mitigating your downside risk, but certainly by no means are you eliminating it. And in certain scenarios, you're increasing your return, assuming the market return is going to be higher. If we're talking about a structured growth note or even a dual directional, where you can generate a positive return in a down market. But all that risk is for a separate video. I want to focus on the second risk, which is the credit worthiness of the underlying bank that issues the note. So when you're looking at the major rating agencies on the screen right now, it is really kind of overview of their different ratings they assign to different banks or different debt issuers. And if you look, there's really a line kind of right here in between the triple B and the double B, where it changes from good credit quality, currently low credit risk, that's your triple Bs, to the double Bs, where you're talking more speculative elements, or the issuer faces major uncertainties and adverse conditions. So certainly as a fiduciary, and if you're looking to protect investments from all directions, you want to focus with triple B or better, preferably triple A or double A. So I'm going to go to the next screen, which is a list of all the banks that we currently use for structured notes. Ideally, what you want to see is, in addition to laddering in notes with different maturities and different underliers, we like to use different banks as much as we can. As an independent investment advisor, we're not beholden to any one bank where we have to issue our own product or buy our own product to put into a client's account. So for example, if we were Morgan Stanley, we're primarily going to be using Morgan Stanley notes, thus opening up our clients to limited diversification and concentration in risk in Morgan Stanley, or if we were JP Morgan advisors. We can use any bank that we want, and what we typically see happen is over a certain period of time, for a couple months, one particular bank will offer more competitive terms than all the other banks by a wide margin, and then that may change a few months later. So what I mean by that is, let's say right now it seems to be JP Morgan Chase, specifically when it comes to growth notes tied to the indexes with a leverage return and downside protection. When we're shopping, and let's say we want a note with the highest leverage possible on the S&P and the NASDAQ with a 30% barrier, for the past month, they've been coming back the best. So we'll go with JP Morgan in that case, which we're looking at a rating of A- from Standard & Poor's, AA from Moody's, and AA- from Fitch. So we're in that investment grade category. In 2 months could be a different story. It may be Barclays that's coming back the best on growth notes, and maybe Bank of Montreal coming back with the best terms on structured income notes. So that's typically what we see. But when you look at the ratings overall, remember on the previous slide, what we're looking to avoid is anything double B, certainly single B. We want triple B or better, which is going to minimize your risk of default. Now, of course, when you look at this list of banks, a lot of these are the largest banks in the world, which could be considered in the too big to fail category. But as we've seen in the past, when we're really dealing with kind of an economic meltdown, even these large banks can absolutely fail. So when we look back, 10, 15 years ago, we may have seen Lehman Brothers on this list with a triple B rating. So certainly in the worst case scenarios, which you always want to plan for the worst, hope for the best, diversification among banks is very important. but here's your risk level. You're looking at investment grade when it comes to the potential of the bank defaulting. You could look at it as a minimal risk, especially when we're getting notes from, Bank of America or Citigroup or Goldman Sachs or BNP Paribas, the 9th largest bank in the world. Nonetheless, it's still a risk. So if you want to learn more about how to diversify a portfolio and create a ladder spreading risk across the major banks, we'd certainly be more than happy to help you. And I hope that this kind of gave an explanation of the types of banks that are issuing structured notes that we're using in our portfolios. Thanks, everyone. Take care.